This chart breaks down global venture capital for 2025. This massive block represents 57.9% of all startup capital going exclusively into AI. Look at the market. Companies reach $500 billion valuations while generating roughly $6 to $10 billion in annual recurring revenue. The math is stark. You cannot maintain $500 billion valuations on a fraction of that in revenue without burning huge amounts of cash. A market correction is inevitable. The strategic question you need to ask yourself is not how to avoid the burst, but where you need to be positioned when it happens. Economists call what we are experiencing an inflection bubble. Unlike a housing crash that leaves behind empty neighborhoods and destroyed value, inflection bubbles actually build the future. In the late 90s, telecom companies spent billions laying fiber optic cables. Most of those builders eventually went bankrupt, but the physical cables stayed in the ground. They became the backbone of the modern, practically free internet. Today's AI companies are doing the exact same thing. They are taking massive amounts of venture capital and using it to build nuclear power facilities and giant microchip fabrication plants. As a market participant, you have to choose your lane. You can build base AI models, create specialized software agents, or invest in raw physical infrastructure. Your survival depends entirely on understanding exactly where you fit into this new technology stack. Let's look at this diagram. The bottom tier of the AI stack represents the foundational models and physical infrastructure. Competing down here requires securing gigawatts of power and massive GPU clusters. Amazon alone brought online nearly 4 gigawatts of power capacity in a single year just to support their data centers. This space is dominated by giants. They are spending tens of billions to train models that serve as the baseline utility for the industry. Because the capital requirements are so steep, this layer operates as a natural monopoly. A few massive winners take almost the entire market. Unless you have a $1 trillion cloud provider backing you, trying to build a foundational model today is a guaranteed path to total capital loss. Moving up to the middle tier, we find the vertical specialists and industry-specific co-pilots. These companies rent the intelligence of the bottom tier and combine it with deep proprietary data. Think of an AI trained specifically on legal precedents or a tool built exclusively for medical billing codes. Because they solve highly specific problems, these tools are finding immediate paying customers and generating strong annual recurring revenue right now. But there is a major trap: absolute vendor dependency. Your entire business model relies on the foundational giants keeping their API traces stable. These niche applications are lucrative today, but they are incredibly vulnerable. Tomorrow, OpenAI or Anthropic could update their base models to include your specific feature for free, wiping out your margins overnight. That brings us to the top of the stack: autonomous agents. Legacy chatbots just give you text answers. Modern agents are given a goal, and they go out and click through software, write code, and execute tasks on your behalf without human supervision. Big tech sees this as the final battleground. Meta, for example, just spent billions acquiring 4 different agent startups in a span of 4 months. They aren't buying models, they are panic buying the teams that know how to orchestrate actions. Owning the agent layer today is like owning the web browser in 1999. It determines how the user interacts with everything underneath it. This makes the agent layer highly volatile. You have the highest potential to disrupt daily workflows, but you are competing directly with Meta and Google for user attention. Now that we know the structure of the stack, we can map out exactly what you should do based on your position in the market. If you are an enterprise leader, look at this matrix. You should be buying specialized agents right now to capture immediate productivity gains, while avoiding the massive cost of building your own in-house models. Treat these purchases as short-term operating expenses. The market is consolidating fast, and you will likely have to replace these exact tools in 2 years anyway. If you are a startup founder, you should ignore the foundational layer entirely and build strictly at the agentic orchestration layer. Because the base layer beneath you is constantly shifting, you have to optimize for extreme speed. Your most realistic goal is an early acquire hire, not building a standalone company that lasts a decade. Finally, if you are a tech investor or strategist allocating capital, your playbook looks entirely different. You need to invest in the physical constraints holding the industry back. That means backing microchip fabrication plants, power grids, and data center cooling systems. These are hard assets. Cloud providers are signing facility leases modeled for a 15 to 20-year return horizon. You need the exact same risk tolerance. The reality of 2026 is that current cash burns cannot continue forever. A market correction will happen. But when the dust settles, the physical data centers and the cognitive models will remain, heavily discounted or practically free. If you position your capital and your strategy correctly today, you will survive to build on the foundation they leave behind.